A very good morning, friends. So welcome you all back to the classes of ICAI. So we've got something very interesting today, and I think the name itself, gives you a lot of energy early in the morning. And we are starting with financial instruments. Well, this is a very important topic to begin with. If you look at from the examination point of view, it's a very, very important topic indeed. I don't think so. We can imagine a question paper without the presence of financial instruments within the paper. I would say, if somebody would tell me that what is the heart and the mind of, financial reporting, I would say financial instruments is like, the heart and the mind. It's one of the pillars in terms of the main, you can say the foundations as far as the Indian accounting standards are concerned. Nevertheless, it is a very interesting topic, but of course it has got its own technicalities and integrities as well. But of course, we are going to, actually deep dive into this topic from the examination point of view, of course. So terms and conditions apply, and what are the terms and conditions that you need to give me a full attention in terms of the topic? Undoubtedly, that goes without saying. And I guess, of course, you'll give your full attention to the topic as well. And we are going to understand the concept. I would request and I would insist that we should understand the larger concept in this particular standard. Don't try to cram anything, just go deep into the logic in terms of things. That will give you a better understanding, not only from the examination perspective, but also give you a good knowledge from the point of view of the professional world as well. So I think on that very basic input about the standard, let's begin the journey on the chapter number 11 of the study mat, Accounting and Reporting of Financial Instruments. Well, I think let me also tell you that the number of classes we're going to spend on this is quite a good number. We're going to spend 10 classes on financial instruments. So of course, we are going to go in detail. So don't think that we're going to go, superficial on the topic. We are definitely going to go deep into this particular topic. So let me start the journey on financial instruments. In between, if you've got any questions, please, feel free in terms of asking questions. Whenever you feel, you can put your questions across. I'll be happy to answer them. So I guess let's start the journey on financial instruments. Well, I guess before I define what is financial instruments, before I define what is financial instruments, because every time you look at a topic, the very first question what comes to the mind is what is a financial instrument? But before we come to what is a financial instrument, let me first tell you that there are a total of 3 standards which are dealing with the concept of financial instruments. So let's first have a look at the name and the number of the standards which deals with the concept of financial instruments. There are a total of 3 standards which addresses the issue as far as financial instruments are concerned. And I think I don't want to scare you at this stage, but you can well imagine if there are 3 standards addressing a same topic, you can of course imagine the kind of intensity the standard has got. The standard setters had to create a total of 3 standards addressing the same topic. You can well imagine the kind of intensity, and this is the only standard which has got a total of 3 standards devoted to it. The first standard is what we call, the number is Ind AS 32. The second one is Ind AS 109. And the third standard is Ind AS 107. So this is the number of the standard. Let's also give you what is the name of the standard. If you look at Ind AS 32, Ind AS 32 talks about financial instruments presentation. It talks of financial instruments and it talks about presentation. Now, presentation where? When you look at a presentation, you can say the presentation could be in the financial statements, but when I'm looking at the presentation, the focus is the balance sheet. So here, when you're looking at the presentation of financial instruments, the presentation is in the balance sheet. Little early to tell you, but I think I just want to give you a very basic introduction at this stage. Imagine a company issues an instrument. Let's say, for example, it issues equity share. So when a company would issue equity shares, it will have to decide whether it is to be presented. Mind the words. When the company issues an equity shares, it is to decide whether it is to be presented on the liability side as an equity or as a liability. When I say equity, it is supposed to be own funds. And when I say liability, it is supposed to be a loan funds. So Ind AS 32 tackles the issue that instrument is to be presented either as equity or as a liability on the face of the balance sheet. So it does not really give you much accounting. Ind AS 32, I would say, is basically giving you exposure in terms of how the instrument is presented on the face of the balance sheet. Mind each and every word of what I'm saying. So in this particular case, when you look at the concept of presentation, the concept of presentation is, do we present it as an own funds, that is equity, or do we present it as a loan funds, that is a liability, on the face of the balance sheet? Next. As far as Ind AS 109 is concerned, the name is Financial Instruments Recognition and Measurement. The name of the standard is Recognition and Measurement. So the focus is on two aspects in terms of Ind AS 109. Recognition and measurement. Well, when you decide and meet the definition of any asset or liability for that matter, the next agenda is, do we recognize it in the balance sheet or not? And once we recognize it in the balance sheet, what is the value at which it is measured in the balance sheet? So this standard is going to deal, of course, with the core accounting effect of a financial instruments, that how do you initially recognize and measure a financial instrument? How would at each balance sheet date on a subsequent basis the financial instrument is going to be considered? So I would say the focus out here is completely on the accounting aspect. And I think, let me tell you one thing point blank at this stage. You need to first of all understand Ind AS 32, then only you can appreciate and understand Ind AS 109. You cannot go the other way around. You cannot first understand 109 and then go back to 32. So the sequence in which we are going to proceed is going to be Ind AS 32 followed by Ind AS 109. And then finally, we've got Ind AS 107, and the name of the standard is Financial Instruments Disclosures. Financial Instruments Disclosures. And I think needless to mention that when I am looking at the concept of disclosure, the focus is mainly on disclosures where in the notes to accounts. So which means that the companies will be required to give some elaborative disclosures in the notes to accounts. So these disclosures are going to be given in the notes to accounts. Well, if you ask me from the examination point of view, of course, the focus is going to be on Ind AS 32 and Ind AS 109. Automatically, once you know Ind AS 32 and 109, you would, of course, automatically understand Ind AS 107 as well. So our focus, of course, is going to be on 32 and 109. So I think what we get settled in the mind is financial instruments. I'm yet to understand what it is, but we've understood that financial instruments has got three standards with us. One is 32, presentation in the balance sheet. One is 109, which is talking about the recognition and measurement. What is the value at which it is initially recognized in the books? What is the value at which it is accounted at each balance sheet date? And finally, what kind of disclosures are made in the notes to accounts? So I think let's begin a journey in terms of Ind AS 32, where the definitions are all contained in 32. So my focus now is to understand what is a financial instruments. And as I said, all the definitions related to financial instruments are contained in Index 32 itself. So let's begin the journey and let's first of all understand what is financial instrument. So I'm calling it as FI, that is what is a financial instrument. Now, if I just go back to Index 32 and I read the definition, I'm just going to quote unquote what the definition is given in the standard as far as financial instrument is concerned. The definition says it is any contract. The word which is used in the standard is that financial instrument is any contract. And I think before I take it further, I want to look at the focus. The word is contract. So let me focus on the word that when I say financial instrument, the focus is it is any contract. Now, when you say that there is a contract, we all know that a contract involves a minimum of two parties. Whenever there is a contract which is entered into, the contract has got a minimum of two parties. So which are the two parties in terms of financial instruments? Let's call them two names. When you look at the two parties in terms of financial instruments, I would say one of the party is called issuer and the other party is called the holder. So when you're looking at the two parties in terms of financial instruments, we can say that there are going to be two parties. One is called issuer and one is called the holder. Now let's take an example to understand who is an issuer and who is a holder. For example, if you look at a company A Limited, it issued shares. Let's say a company A Limited issued shares. I think by the very nomenclature, you can easily guess that A Limited is supposed to be the issuer of the instrument. A company which will issue the instrument is called the issuer. And this company is going to take a decision whether it is to be presented on the liability side as equity or as liability. Mind the words. When a company A Limited, in my example, issues an instrument, it needs to take a decision whether this instrument is equity or is it supposed to be a liability. Now let's say, for example, a company B Limited made an investment. He invests into these equity shares. Now when he is going to make an investment into these equity shares, you can say B Limited becomes a shareholder of the company. So when you say that B Limited becomes a shareholder of the company, then we can say that B becomes the holder in this particular case. And as a holder, you are going to definitely present it on the asset side of the balance sheet. So the most important and the crucial point is that when you look at A Limited, who is the issuer of the instrument? He needs to take a decision that is it to be presented in the balance sheet as equity or is it to be presented in the balance sheet as a liability. And when you look at B Limited, who made an investment in these particular shares, we can say B Limited is supposed to be the holder and he will definitely reflect it in the balance sheet on the asset side undoubtedly. So who is required to take a decision from the presentation point of view? If you look at the agenda, the issuer needs to take a decision. Is it equity or is it liability? The holder is not required to take a decision. Because even if the issuer says it's an equity, it is still an asset for the holder. Even if the issuer says it's a liability, it is still an asset for the holder. So the decision of presentation, I would say mainly, is supposed to be applicable from the issuer point of view. The instrument is issued by a company and it needs to take a call whether we present it as equity, that's called own funds, or is it a liability, that is called a loan funds. So coming back to the definition. So we said that financial instrument is any contract. So immediately what should come to your mind is when you look at a contract, the contract has got a minimum of two parties. In terms of financial instruments, the two parties are technically called the issuer and the holder. Issuer is the one which is going to issue any instrument, and it is to be presented on the liability side of the balance sheet as equity or as liability. And the holder is the one who's made an investment in those instruments, and it is to be presented on the asset side of the balance sheet. Though we are going to give the liability a specific name, and we're going to give the asset also a specific name, which I will shortly give you. So we can say, coming back to the point, when you say that it is a contract, now I can say it's a contract between two parties. I'm just replicating that part. So we are saying that this is a contract between two parties. One is called issuer, as I've already mentioned, and one is called the holder. Now, just to organize the data very carefully out here, so we can say the issuer will decide, is it equity instrument? I'm now giving some new nomenclatures to the word equity and liability. So the issuer will take a decision whether it is supposed to be an equity instrument, call it simply as equity, or it is a financial liability, that's called it as FL. I just slightly made a change in terms of terminology. As I said earlier, it's equity or liability. Now we're giving a name. Equity is called as equity instrument, or a liability is going to be called as a financial liability. And correspondingly, this will become a financial asset for the holder. So instead of just calling it as an asset, we're going to call it as a financial asset. So we can say it's an equity instrument for the issuer, but it becomes a financial asset for the holder. It's a financial liability for the issuer, but it still remains a financial asset for the holder. So the focus undoubtedly remains out here that we need to basically take a decision for the issuer. I need to basically take a decision from the issuer point of view that is it to be presented as an equity instrument or is it to be presented as a financial liability. I hope the basic concept of what is a financial instrument is clear. I am getting some wonderful answers also coming in from your side. That's great. So let me just quickly consolidate the insights and then we'll start working on the elements of the definition of financial instruments. So your focus has to be very clear at this particular stage that when you look at the word financial instrument, immediately your mind should tell you that there is a contract with two parties. So the company which is going to issue the instrument is called the issuer, and the company which makes an investment in that instrument is called the holder. The issuer needs to decide the presentation in the balance sheet. Is it equity instrument or is it a financial liability? The holder in any case will only say it's a financial asset. So I guess one thing which is visibly clear, but I think I just want to put this out here. Can I say, if you need to understand the definition of financial instruments, you need to understand what is a financial liability. You need to understand what is an equity instrument, and you need to understand what is a financial asset. In order to appreciate the definition of financial instruments, there are three terminologies used in the definition. That is a financial liability, equity instrument, and a financial asset. If you are able to understand these three elements, we are able to understand what is a financial instrument. So let's do one thing. Since the focus is on the issuer perspective, let's focus on the definition of a financial liability as well as an equity instrument. Let's not talk about a financial asset at the moment. And trust me, once you're done with the definition of a financial liability, the definition of financial asset is nothing but a mirror image of a financial liability. The moment you are able to understand a financial liability, automatically you'll understand what is a financial asset. So I'm going to focus first of all on the concept of financial liability as well as an equity instrument. So let's begin the journey. So my focus right now at this stage is on the concept of financial liability and on the concept of an equity instrument. Now, what am I going to do? Let me tell you in advance. I am going to develop a step-by-step model in terms of deciding whether the issuer will classify the instrument as a financial liability or whether he will classify the instrument as equity. Now, as I develop this three-step model, there will be certain logics also which will be required, which of course I will give you. But I think it'll take me some time. So let me explain my strategy to you so that you are absolutely in consonance with me. I will first of all give you a step-by-step model and the logics will come thereafter. It will not be difficult to give you the logics immediately. First, I'll give you a chain of thought that this is how you need to apply a step-by-step approach. And then we'll understand the logics as well. That is one. Now, as I develop a step-by-step approach in terms of deciding is it financial liability or equity instrument, I am going to develop this model in three phases. I'll give you a version 1, then I'll give you a version 2, and then I'll give you a version 3. So I will be developing this model in three stages. I'll give you a version 1. After you've understood the version 1, I will then override it and give you a version number 2. Once you've understood the version number 2, I'll override it and give you a version number 3. Now you will say, sir, why don't you give us the version number 3 directly? Not possible, dangerous indeed. If you're new to the concept of financial instruments, we need to understand and appreciate the concept on a step-by-step basis. So no hurry. We are going to first develop a version 1. I'll give you the steps. We'll develop the logics as well. Then the version 2, then the version 3. So we'll go stage by stage, version by version, and we're going to go step by step. So let's begin the journey with the version number 1. So I am going to give you, first of all, the version number 1. So I'm giving you the first version of the three-step model on deciding whether the instrument is a financial liability or is it an equity instrument. Now watch this carefully. Logics, I said, I'll give you very shortly. Don't worry on the logics. I'll explain them, but first understand the steps. Well, first of all, in terms of step number 1, imagine the same example where A Limited issues equity share. Or imagine the example that A Limited issues debenture. So I will put a question to A Limited that is there a contractual obligation? So I am putting this question to the issuer. That is A Limited in the example, that is there a contractual obligation? So in step number 1, I will put across a question that is there a contractual obligation? Underline the word contractual and underline the word obligation. So you need to put across the very first question to the issuer that is there a contractual obligation? Now, what is important out here is that the obligation is contractual in nature. Let me make it very clear. I'm not saying it is legal. I'm not saying it is legal. You know, when you look at a legal obligation, if you remember what you've done in Index 37, I'm just reminding you what you've done in Index 37. In terms of Index 37, when you say the obligation is legal, the legal obligation is including two kinds of obligation. The legal obligation is including an obligation by law and an obligation by contract. Mind this very carefully, because many times We tend to get confused on the concept of legal and a contractual obligation. So when I say it's a legal obligation, the legal obligation can be by virtue of law. The law of the land tells you to do something. And there can be an obligation which is contractual. Now here you can see we are saying the obligation is contractual in nature. So we are looking at only one component of the legal obligation. So I'm not considering the obligation to be legal. I'm only considering it is contractual in nature, which is only a one component of the legal obligation. So let's take an example to understand when the obligation is legal and when it is contractual in nature. For example, let's say, for example, a company A Limited took a loan from the bank. If company A Limited took a loan from the bank, then I can say A Limited has got an obligation which is contractual in nature. Because A Limited and the bank would have entered into an agreement, and therefore A Limited is contractually obliged to pay the money back to the bank. So it is the obligation which is contractual in nature. Okay, I'm getting another question. So just joined in, eagerly waiting for your session since months. Thank you. Really, your teaching is very awesome. Thank you so much. You made my day early in the morning. I was also eagerly waiting, to meet all of you, and I think finally the day has come. Okay, so the focus is in terms of obligation being contractual in nature. So as I said, the contractual obligation is just one element of a legal obligation. When you say the obligation is legal, it is by law and it is by contract. But here the focus is only that we are looking at contractual in nature, not the entire set of legal obligation. So I give you an example in terms of a contractual obligation. A Limited took a loan from a bank. So they would have entered into an agreement where A Limited has got an obligation which is contractual in nature. Let's take another example. As an individual or even as a company, we are liable to pay taxes to the government of India. Now, is this payment of taxes a contractual obligation? Of course not. The obligation to pay taxes is something which is statutory. It is an obligation by law. Therefore, it will fail the step number one. So it is very crucial to understand the step number one, where the focus is the obligation is arising because of a contract. So once you zero down that yes, the obligation is contractual, we go to step two. I hope I am pretty clear with the concept of my step number one. You need to focus on step one. Is the obligation contractual in nature? So once you put across this question that the obligation is contractual in nature, you would get the answer either a yes or you would get the answer either a no. So let's put it like this. The answer comes a yes or the answer comes a no. Well, if you get the answer no, in that particular case, the standard on financial instruments are not applicable. Because if you say the obligation is not contractual, I am not covered under the standard, because financial instrument is any contract. So we can say the financial instrument standard is not applicable in this case. But if you say a yes, I am ready and I am ready to go to the step number two in this particular case. I hope, friends, I am pretty clear in terms of my step one. Yes, I got the inputs. Yes. So your focus would be, is the issuer got an obligation which is contractual in nature? If you say no, the standard does not trigger. And if you say yes, I'm ready to go to step number two. Now let's go to the step number two. Now the step number two is a very important, crucial step again. When you zero down on the fact that the obligation is contractual in nature, your next agenda is to identify the mode of payment. Mind the words carefully. Don't worry, we'll be taking a lot of examples also. from the study material, though it's too early to give you any examples at this stage. I will take some time before I build the concept. Then we'll do a lot of illustrations as well in order to get the concepts very clear. So in terms of the step number 2, your focus is going to be on the mode of payment. As an issuer, I've got an obligation which is contractual. What is the mode of payment? How will I discharge my obligation? Well, I would say mainly, at least from the examination point of view, I see that there will be only two modes of payment. Either I'll make a payment in terms of cash, or I'll make a payment in terms of shares. A company uses its own equity share as a currency note to make a payment. Let's say, for example, I owe a payment to another company, B Limited. I tell the company B Limited that instead of giving you cash, why don't you accept equity shares of my company? So I could use equity shares of my company as a currency note in order to discharge the obligation. I would say this was almost the first time in the standards where the equity shares of a company is being considered as a currency note. The company could use its own equity shares as a currency note in terms of discharging an obligation. So your step number 2 is going to focus in terms of what I call the mode of payment. What I call the mode of payment. So it's going to be crucial to take a call and decide that when you are going to discharge the contractual obligation, what is the mode of payment? So I would say there are two modes of payment. Now you would say, sir, is this an exhaustive mode of payments? From the examination point of view, more or less, you can say a yes. But technically, if you ask me that is this a mode of payment which is exhaustive in nature, I would say no. But for the time being, you can understand that yes, the mode of payments which I'm giving you is more or less an exhaustive mode of payments. So either the payment is made in the form of cash, or the payment is made in the form of equity shares. A company uses its own equity share as a currency note. I think I'd like to make a mention at this stage. So when I'm looking at equity shares, we can say the company means the issuer, uses its own equity shares. It uses its own equity shares as a currency note. So this should be very clear in your mind that what the issuer is doing, he is basically considering his own equity share as a mode of payment. I tell the other party that I am going to give you my equity shares in my company and I use them as what we call as a currency note. Because generally when you make a payment, the payment is going to be made in the form of, you can say, cash. That is legal currency of the country. But then the standard also allows you that you use your own equity share as a currency note in order to discharge the contractual obligation. Now, as I say something more, you will accuse me so that you are trying to make cram things to me. As of now, yes. But I will give you the logic also as I promised. So for the time being, I am just telling you some inputs. I will give you the logic as well. Now, if you say the mode of payment is cash, I will call it as a financial liability. I know you're going to say, sir, you are making me cram. You are saying that the mode of payment is cash, it becomes a financial liability. Why? Don't worry. I will give you the logic. As I said, first understand the steps, then the logics will come later. So for the time being, just remember that if the mode of payment is cash, it is going to be called as a financial liability. Why is it going to be called as a financial liability? I'll clarify the agenda after next few minutes. If the mode of payment is equity shares, I will say let's go to step number 3. Let's not hurry up the situation. We're going to go to step 3. So I hope my procedure, not the logic, the procedure of the step number 2 is clear. If your mode of payment is cash, it's a financial liability. If your mode of payment is equity shares, we go to the step number 3. Let's take it further. Now we go to the step number 3. When the mode of payment is equity shares, now let's see what is to be done. Hear me carefully on step 3. I decide as an issuer, mind the words. I decide as an issuer that I will give the holder a certain number of shares pre-decided. That is called a fixed number of shares. I tell the holder in advance that I will give you a predetermined number of shares decided as of today. The number of shares to be given will be in the future. The number of shares to be given will be in the future, but I say I will pre-decide the number and I'll give you this pre-decided number in the future. So I'll land up giving him what is called a fixed share. Or I don't decide the number today, but I'm going to decide a number later. I think let's explain this with an example. So before I come to the step number 3, let's take an example to make you understand what is fixed and what is, a variable number of share. Let's take an example. Let's say, for example, A Limited approaches B Limited for a loan, let's say to the extent of 10 lakhs. A Limited approaches B and says, I want a loan of 10 lakh rupee. A will pay the interest every year. I'm ignoring it for practical convenience. Mind you, A will pay interest to B on this loan. I'm ignoring it for practical convenience. I'm just concentrating on the principal amount, how the principal amount is paid. Now see the two features, what A tells B. Now A is telling B, number 1, I need to pay you 10 lakh rupees, let's say after 5 years. A is telling B that I borrow this 10 lakh from you from today and I need to repay this money after 5 years. Now A is telling B that the price of my share today, is supposed to be 500 rupees. So I owe you 10 lakh rupees. So let me do one thing. He tells B that let me divide 10 lakhs by 500 and I am going to give you 2000 shares. So A pre-decides the number of share. A pre-decides the number of share and tells B that after a period of 5 years, I'll give you 2000 share. Remember, this is decided today. And this will be given after a period of 5 years. You tell Mr. B, you tell B Limited, I will give you 2000 shares, which is a pre-decided number. This is called a fixed number of shares. So A tells B that I will give you a fixed number of shares in order to pay this obligation. Number is decided as of today and it is going to be discharged after 5 years. Let's look at a second combination as well. A is telling B Limited that I need to pay you 10 lakh rupees. It's unfair to decide the number today. A tells B that it is unfair that I decide the number today. Let me decide the number after 5 years. He tells B Limited that if the price of the share, whatever is the price of the share after 5 years, whatever is the price of the share after 5 years, I will divide 10 lakhs by the price after 5 years. So if the price of the share, let's say after 5 years is 1000, he says, I'll give you 1000 shares at that time. He says, let me not pre-decide the number. He tells B Limited that let's see what is the price of the share after a period of 5 years. And he says that I will give you as many shares based upon the price. He says, let's say, for example, the price of the share after 5 years is 800. Then I will issue a total of 1250 shares to you. So he doesn't define a pre-decided number. He doesn't tell him a fixed number of shares, but this is called a variable number of shares. This is called a variable number of shares. So when A discharges the obligations and it is in the form of its own equity shares, mind the words, A uses his own equity share as a currency note to pay off the obligation. It all depends upon, is he pre-deciding the number? Is the number of shares to be given pre-decided, fixed in number, or is the number of shares to be decided at a later date? And trust me, if the number is pre-decided, it is fixed in nature, it is going to be called as equity instrument. And if the number is going to be variable in nature, the instrument is going to be called as a financial liability. Sir, you're making us cram. You told us that if the mode of payment is cash, it's a financial liability. You said if the number of share is fixed, it's equity instrument. You said if it is variable, it is financial liability. But what is the logic? No worry, as I said, the logic will also come. First, let me give you the rules, and then we'll develop the logics of those rules to make them principles. Because we will have a lot of judgments in terms of making decisions whether instrument is equity or whether the instrument is a financial liability. But let's first get the rules very clear. So in my example, just to take a recap, when A has taken 10 lakhs from B and A pre-decides the number, he tells in advance to B Limited that I will give you a fixed number, a pre-decided number. It's an equity instrument. But in this particular case, when A tells B that I will not pre-decide the number, but I will decide the number after 5 years. Depending upon the price of the share which is prevailing after 5 years, I'll decide the number at that particular stage. If the number is variable, it becomes a financial liability. Did you get the principles, friends, at this stage? Not the logic, the principles are clear that now if you're looking at step number 3, you're focusing on the number of shares. And when I'm focusing in terms of number of shares, I would say either it is fixed or I would say it is variable in nature. So we can say the number of shares is either predetermined fixed in number, then it is equity instrument. And if it is variable in number, then it is going to be called as a financial liability. Okay, let me do one thing. Let me just consolidate the 3-step model to you before I take it forward. So let me just, I think, come back to the agenda. So let me just quickly consolidate the inputs back to you. We'll get the focus of the version 1. Don't worry, I am going to give you the logic very shortly. After I have just consolidated my 3-step model, I'll give you the logics as well. So remember, when you're looking at the decision from the issuer point of view, please hear this very carefully. It's a consolidation of what we have learned in the last 15-20 minutes. So I'm saying that when you're looking at an issuer point of view and you need to decide the instrument is a financial liability or is it an equity instrument, your version number 1 in terms of the 3-step model, the focus 1. We need to see that is the issuer got an obligation which is contractual in nature. When you look at the concept of contractual obligation, remember, contractual is a subset of a legal obligation. When you look at a legal obligation, it is by law and it is by contract. So my focus here is not on the entire legal obligation. My focus is in terms of obligation which is contractual in nature. So you need to put a first question to yourself, is the obligation of the issuer contractual in nature? If you say no, standard is not applicable. If you say a yes, you need to go to the step number 2, step by step. In terms of the step number 2, the focus is on the mode of payment. The obligation will be discharged, so I am concerned with the mode of payment in which the obligation is paid. If your mode of payment is cash, I said it's a financial liability. And the mode of payment is shares. The company, the issuer, uses its own equity share as a currency note to discharge the obligation. The standard allows a company, an issuer, that he could, make a payment using his own equity share as a currency note. Then I go to the step number 3, and you need to see, is the number of shares which the issuer is going to issue, is it pre-decided, fixed in number, decided at the very inception of the contract? If it is fixed, it is equity instrument. And if it is not fixed but will be decided at a later date, then it is supposed to be a financial liability. So the focus point is mode of payment cash, financial liability. Mode of payment equity shares, variable, financial liability. Mode of payment equity shares, fixed in number, it is equity instrument. So but then you promised that you're also going to give us a logic that why a mode of payment cash becomes FL, why a fixed share becomes equity, and why a variable share becomes a financial liability. Did you understand the logic, or do I need to elaborate the logic to you? Sir, you never gave the logic to us. So did you understand the logic automatically, or you want me to explain the logic of why we are calling it as a FL or equity in terms of fixed and variable number of shares? Elaborate, please. Okay, so I think I'll do that to you. So let's now understand the logic as well. So let's give you what is the logic of this particular concept. Trust me, friends, for this purpose, I'm going to take you back to the school days. I'm going to take you to the class 11th, where we understood some concepts, and I want to recall those concepts to understand the larger picture. So please hear me carefully. The logics are about to come. I remember when I also studied my class 11th, I remember we were taught in school that there are two kinds of funds. Please hear this carefully. The next 5-10 minutes is going to give you the logic of my version 1. So I remember when I was in school, at that time we were told that there are two kinds of funds. One is called own funds and one is called loan funds. And of course, later we also understood that own funds is nothing but it is equity, and loan fund is nothing but it is supposed to be a liability. Now we were given a very simple inputs in terms of deciding whether the funds are own or whether the funds are loan funds in nature. So we were given that there are two parameters. The parameter number 1 is what we call return. The parameter number 2 is what is called the principal repayment. So there are two parameters which decides whether it is own funds or it is supposed to be a loan funds. So we were given two parameters. One is called the return and one is called the principal repayment. When we borrow money or when we raise money through equity shares, there are two aspects in terms of the funds raised. As an issuer, I am obliged to pay interest and dividends on that money. That is called a return. As an issuer, I'm responsible to make a repayment of the principal money as well. So let's understand and let's try to recap that in class 11th, what did we understand as far as a loan fund is concerned? Now, if you take, let's say, a loan from someone, let's say you raised money by way of a loan, are you obliged to pay interest? Even if the company does not earn a profit, is your obligation to pay the interest remains? Yes. So can I say return in this particular case is mandatory? The return in this case is mandatory. As an issuer, if I take a loan from a bank, my liability to pay the interest on the loan is there even if I don't earn profits in the company. I've got to unavoidable obligation to pay interest even if I do not earn any profits? Am I also obliged to repay the principal money as well? Yes. There will be a certain span of time and you will have to repay the principal money as well. So which means you are obligated in terms of making an interest payment. You are obligated in terms of making a principal payment after a certain number of years. So your obligation is there in terms of return and in terms of principal. But if you look at the concept of own funds, is a company liable to pay dividends to the equity shareholders of the company? And the answer is no. It is completely optional. I have got no obligation to pay any kind of dividends. Even if I earn a profits in the company, I am under no obligations to pay any kind of dividends to the shareholders of the company. Am I liable to repay the principal? No, only in the event of liquidation. There is no fixed tenure. I am not liable to pay this money after a certain number of years. I will be liable to repay the money only if the company liquidates. So this is only repaid on liquidation. And that also if anything is left over. The liability to pay the equity shareholder of the company triggers in the event of liquidation, and that also if there is something which is still left over. If there is nothing left over, then they may not be able to get anything. Now, I have very simple questions to ask you. Let's get the insights at your end. Number one, I want you to make an analysis of this case and tell me, looking at this particular situation, I want you to look at things from the point of view of a risk. I want you to look at the things from the point of view of the risk. When a company issues an equity shares to the equity shareholders of the company, when a company issues equity share to the equity shareholder of the company and tells him, as far as returns are concerned, optional. As far as the principal is concerned, if I liquidate, I pay you. If anything is left, I pay you. Who is the risk taker? Can you tell me who is taking a risk? Is the risk taken by the company, the issuer, or is the risk taken by the equity shareholder in this case? Tell me who is taking a risk in this particular case. And that's right, the risk is taken by the shareholder in this particular case. Superb. Now imagine if the company is raised money by way of a loan. You are telling the loan holder, I'll pay you interest even if I don't earn money. I'll pay the principal money back after n number of years. So in this particular case, considering this input, who do you think is taken a risk? Is the risk taken by the company, the issuer, or is the risk taken by the holder? The issuer is telling the person, I pay you interest even if I don't earn money. I pay the principal money back. So who is the risk taker, the issuer or the holder? And that's right, the risk is taken by the issuer. So now we need to understand one very important element. The classification of the instrument as equity or a liability depends upon the risk element. Please get this very clear. The classification of the instrument as equity, that is own funds, and liability is all based on the risk perception. Now, if you see clearly, I can definitely conclude, if the risk is by the holder, it becomes an equity. If the risk is by the issuer, I'll call it as a liability. I hope I'm very clear on the agenda. So when I say it is equity funds, I'm saying the risk is on the holder, not on me. When I'm saying it is supposed to be a liability, the risk is on me as an issuer. So when the company, the issuer, takes a risk, it is supposed to be a financial liability. When the risk is passed on to the holder, then it is supposed to be an equity instrument. Now, let's apply this back and let's put those questions back to you. Let's see, what do you have to say on this? If the liability is paid in cash, the issuer tells the holder, I will pay this money to you in cash. Is there a risk of the issuer or is there a risk of the holder? Decide. As an issuer, I'm telling the holder, I will give you the currency, the legal currency notes. And I am obliged to give you this legal currency note. Can I say in this case, the risk is taken by the issuer? If the risk is taken by the issuer, can I say in this particular case, it is going to become a financial liability? Now let's imagine if you're going to give equity shares in nature. Now please see this carefully. I want to look at the risk perception in this case. As an issuer, I told the holder, I will give you a fixed number of shares. I decide the number today. If the price of the share goes up, your gain. If the price of the share goes down, your loss. Have I passed on the risk to the holder in this case? If I pre-decide the number of shares, am I indirectly passing on my risk to the other party because I decide the number in advance? If the price of the share goes up, he gets the benefit as the holder. The price goes down, he loses as a holder. So can I say in this case, the risk is on the holder? If the risk is on the holder, it becomes an equity instrument. And if you decide a variable number of share, you're telling the other person, don't worry. I will give you as many shares, you get your money back. If the price of the share after a period of 5 years is 800, I give you more shares. If the price of the share is 1000, I give you less shares. So I give you as many shares so that you get your entire money back. The risk in this particular case belongs to whom? The risk is again belonging to the issuer. I hope I made my point very clear. I made my points with the logic very clear that when the mode of payment is cash, the risk is of the issuer financial liability. When the mode of payment is equity shares and it is fixed in nature, the risk is passed on to the holder, equity instrument. When the number of share is variable in nature, the risk is still with the issuer and it is supposed to be a financial liability. So in those cases where the risk is on the issuer, it's a financial liability. And if the risk is given, passed on to the holder, it becomes an equity instrument in this case. Let me get a good thumbs up from your side. Are you clear with the three-step model and the logics of why it is FL or why is it equity instruments in different permutations and combination? Clear on this? That's wonderful indeed. I have got some thumbs up on that yes, we are clear with the agenda. That's superb indeed. Great, wonderful indeed. Okay, Ayush, said no sir. No sir means you're not clear, or no sir means that there are no questions coming in. I didn't get the meaning of that no. What is that? Okay, and you said sir, but equity shares, the ultimate risk is with the holder. I got your point now. Let's, I think, come back to the example on this and let's, I think, have a look at the example which I gave you. I know there might be a couple of questions coming to your mind regarding the transaction cost of selling the shares, the administrative issues, etc. Let's not get into the administrative inconvenience, etc. Let's put the game very fair. Let's say I need to pay you 10 lakh rupees after 5 years. I need to pay you 10 lakh rupees after 5 years. And I say, let's watch the price after 5 years. If it is 1000, I give you 1000 shares. If it is 800, I give you 1250 shares. Now my question to you, am I giving you as many shares that you sell them after 5 years? Mind the words. Am I giving you as many shares you sell them after 5 years? Will you get your every penny back? Ask yourself a question. If the price of the share is 1000, I give you 1000 shares. If the price of the share is 800, I increase the number of shares. Am I going to give you as many shares that you sell them and you realize the entire 10 lakh rupees? Are you running any risk? If the price of the share goes down, I give you more shares. If the price of the share goes up, I give you less shares. I keep changing the number of shares according to the price prevailing after the end of 5 years. So what is your risk? There is no risk on the part of the holder. because I'm going to give you as many shares that you get your entire money back. Did you get my point? Right? Ayush, did you get your point? Great. So moral of the story, I guess let's consolidate the inputs, then start working on the version number 2. As I said, my 3-step model has got a total of 3 versions. We're just finished with the version number 1. So you mean to say that you've taken almost 1 hour to give your version 1, you're going to take another 1 hour to give version 2, and then another 1 hour for version 3? Not really. Don't get worried on that. I'm not going to spend 3 hours giving you the 3-step model, 3 versions. But yes, after I am done with all the versions as well, I'm going to give you some very interesting charts as well. Then I'm going to do a couple of questions also with you, so that you know the entire concept of Ind AS 32 becomes very strong indeed. What we are studying right now is Ind AS 32. So let me just, I think, consolidate my 3-step model with logics so that we can start working on version 2. So your focus points needs to be very clear. Let's come back on the focus point in terms of 3-step model. You know, when you look at a financial instrument, the first and the foremost important aspect is the presence of a contract. So when you're looking at a financial instrument, your focus one is that the issuer, right now I'm focusing on the issuer, not on the holder. And the reason I gave you is very simple. I said the issuer says it is FL, holder says FA. Issuer says equity, holder says FA. The holder in any case is going to call it as a financial asset. So there is no point of taking any decisions from the holder's perspective. So we are focusing right now on the issuer point of view, and the focus is to decide whether it's FL or equity from the issuer perspective. So when you're going to look at a particular question, you are going to first of all look at the point number 1. The obligation of the issuer is contractual in nature. If I say no, the standard does not apply. If I say a yes, I go to step 2, simple. Then I go to the step number 2, and your focus is on the mode of payment. How would you discharge the payment? And the mode of payment right now has got 2 modes of payments. Either we consider cash as a mode of payment, or we consider your own equity share as a mode of payment. Remember, the logic is if the mode of payment is cash, you are running a risk as an issuer. You need to pay the money to the holder. You're running a risk. It's a financial liability. But if the mode of payment is equity shares, don't hurry, but go to step 3 and decide the number. That in lieu of the payment, are you going to issue a fixed number of shares, pre-decided, predetermined? Or are you going to give a variable number of shares? If it is fixed number of shares, I am passing the risk to the other party. I'm saying I'll give you X number of shares. Now it goes up, your gain. It goes down, your loss. So the risk is on the holder. It's an equity instrument. And if it is variable, you are willing to compensate as many shares so that he gets the entire money back. Then in that particular case, the risk is on the issuer and it becomes a financial liability. I guess before we go to the version number 2, I want to take a little risk, and I want to take you to an illustration in the study mat. Can I take a risk at this stage? Let's see how many of you can answer that question. I am pretty confident. I'm pretty sure that each one of you will be able to answer the questions based on the version number 1. But we might have to revisit on those questions later. We'll do that. Shall we take a risk? Yes, sir. We'll take a risk. So let me, I think, take you to the study material, and we are going to take a little risk at this stage. So this is on the unit number 3 of the study mat. What I'm showing you is based on the unit number 3. So let me just zoom it. Let me know, friends, if this is clearly visible to you. This is illustration from the study material unit number 3. Is that visibility clear? Can you see that clear, I guess? Okay, wonderful indeed. Please don't read the answer. I am going to show you the inputs. You need to decide based on the three-step model and decide the answer. This is a question which I've taken from the unit number 3, and that is illustration number 13. See what a great jump we have made and taken into the illustration 13. CBA issues convertible debentures to PQR for a sum of 100 crores. The debentures are convertible after 5 years into equity shares of CBA using a predetermined formula. Be careful when you read the language of the question. It's not a predetermined number. It's a predetermined formula, so don't get sentimental. It says it's a predetermined formula. It's not a predetermined number. It's just a formula. Look at this formula carefully and analyze. 100 crores into 1 plus 10% raised to power 5. So what is in the numerator? Is he compounding that 100 crores at the rate of 10% for a period of 5 years? That means you're telling the other person that I will pay the money with a compounded interest of 10% for 5 years? Yes. You're saying that 100 crores is compounded at the rate of 10% for 5 years, and it is divided by fair value on the date of conversion. Please apply a three-step model and give me your answer. Is this a financial liability or is it an equity instrument? Okay, so we are getting number of shares a variable. The risk is of the holder, financial liability. We're getting answers, financial liability. I think a lot of answers came to me. It is a financial liability. Absolutely correct. Wonderful indeed. Let me still apply my three-step model in order to get the results very clear. So let me just quickly run this on my three-step model. Number 1, CBA issues convertible debenture. So does CBA got an obligation which is contractual in nature? Yes. When you issue debentures to the company, definitely you've got a contractual obligation to pay. Then I go to the step number 2. What is the mode of payment? The mode of payment is supposed to be equity shares in this case. And if I look at the formula to see the number of share, I am dividing by the fair value on the date of conversion. It's not being decided as of today. It'll be decided on the date of conversion. So the number of shares is variable in nature. And if it is variable in nature, it is certainly a financial liability. Good. It's happy to see that you've all got the flavor of the three-step model. Let's do another illustration as well. And you can keep reading the answer. But of course, the answer out here is, in this particular case, I think I'll just show you. It is not an equity instrument. So it is supposed to be a financial liability. Let's look at illustration 14. DF issues convertible debentures for an amount of 100 crores, and the debentures are convertible after 5 years into 15 crore shares of 10 each. I don't think so. I need to decide that. I am telling the other person, the holder, that after a period of 5 years, I'm going to give you 15 crore equity share. So is it a financial liability or is it an equity instrument? And that's absolutely correct. It becomes an equity instrument. Wonderful indeed. Superb. Let me still apply my three-step model in terms of deciding the answer. So when you look at DF Limited issues debenture, does it have an obligation which is contractual in nature? Undoubtedly, yes. What is the mode of payment in this particular case? The mode of payment is undoubtedly equity shares. And it has already been pre-decided that the number of shares to be given is 15 crore shares. It is a fixed number of shares, and if it is a fixed number of shares, it is undoubtedly an equity instrument. Superb. Imagine if the version number 1 is able to help us answer the questions easily, then my version number 2 and 3 is going to help you more. Great. So I think this is done. I think it was worth taking a risk at this stage. Let's now go to the concept of version number 2. So I'm now going to work upon the second version. I am now going to work on the version number 2. We've already worked on the version number 1. Now I need to work on the version number 2. Now please hear me carefully, because what I'm just about to add is going to be slightly, technical, but of course interesting at the same time. So please hear me very carefully, because I'll now suddenly, increase the level of things. So please hear me very carefully. There are two things which I need to add in terms of version 2. I'm not making any changes on step 1. I'm not making any changes in step 3. I'm going to basically make a change in step number 2. So in the version number 2, my focus is on step number 2. So let me make it very clear. In my version number 2, I am not making any changes in step 1 and step 3. There is no change. I'm not even touching those steps. I'm only going to make a change in terms of the step number 2. That is one focus which we need to keep in mind. So before I make a change to the step number 2, there is another insight which I need to give you. Now, please hear this very carefully. I said the mode of payment is either cash, or the mode of payment is either equity shares. Now, please ask yourself a very simple question. Is it possible that I make a payment of the principal in shares and the return in terms of cash? In other words, obligation of the issuer has got two elements. As I was discussing the class 11 funda, I said that there are two elements of an obligation. One is the return and one is the principal. So there is a possibility that when you're looking at a return, the return in the form of interest and dividend is paid in cash. But as far as the second component of the obligation is concerned, the principal money is paid in terms of equity shares. So there is a possibility that the company makes a payment. The company makes a payment, and I can say if the return is made, the return is given in cash. The principal is made in terms of share. So I might make a payment for each component of the obligation by a separate mode. Please mind the words carefully. My focus now is that when a company makes a payment, you need to see that there could be a different mode of payment for the return element, and there could be a different mode of payment for the principal money. Does this mean that I am supposed to run my three-step model for the two components separately? I run my three-step model for the return element separately and for the principal element separately? Yes. I hope you got my point. Because when you're looking at a particular instrument, the issuer has got an obligation to pay the return. The issuer has got an obligation to pay the principal, and the mode of payment for the return may be a different mode, and the mode of payment for the principal may be different. So one very important input which you need to keep in mind is that you need to run the three-step model. You need to run this three-step model for each component. You need to run this three-step model for each component separately. Now, when I say each component means we're looking at the principal and we're looking at the return. So from today onwards, now you would like to think back and see, so I want to revisit the illustration 13 and the illustration number 14 which we did. Well, if you remember, in those illustrations, the entire obligation, whether it was principal or whether it was the return, was all paid in the form of equity share. I took very safe illustrations indeed. because in both the illustrations, the principal was compounded and then principal and the return both was paid in one mode. But now there is a possibility that you are going to make a payment of return in a different mode and the payment of the principal in a different mode. So what is most important is that when you run this three-step model, run it for the return separately, run it for the principal separately. Interesting. That gives us another very interesting inputs to watch. See, just imagine I am looking at return and I'm looking at the principal. Let me run this three-step model separately for each component and watch this carefully. I decide the interest is paid in cash. If I decided the return is paid in cash, this will become a financial liability. I decided the principal is paid in variable number of shares. I decided the principal is going to be paid in shares, which is variable in nature. That also becomes a financial liability. You apply the three-step model for each component on a separate basis. Mind the words. I apply my three-step model in terms of the return element. I said the mode of payment is cash. It is a financial liability. I said the principal is variable number of shares. It's a financial liability. When both the components are financial liability, overall the instrument will become a financial liability. So when you say both components are financial liability, it becomes a financial liability on an overall basis. Now watch another example. Now let's consider that the return is paid in the form of cash. So it is a financial liability and the principal is paid in terms of fixed number of shares. The principal is paid in terms of fixed number of shares, then it becomes an equity instrument. The principal component becomes an equity instrument, and if one component is financial liability, another component is equity instrument, we're going to call this as a compound financial instrument. Wow. We've understood a new terminology. One of the components is supposed to be in cash. It's a financial liability. Another component is in fixed number of share. It becomes an equity instrument. If one component is a liability, another component is equity, it becomes a CFI, a compound financial instrument. Did you get my point? Did you get my point, friends, on that? I hope I'm very clear on the picture that you need to apply a three-step model to each and every component of the instrument on a separate basis. Apply it to the return element separately, apply it to the principal component separately, decide for each component, is it FL or is it equity in nature? So which means I can now conclude one thing. The combinations which could arise on account of application of this three-step model to each and every component on a separate basis. One component is FL, another component is FL, the instrument is FL. One component is FL, another component is equity, it is compound financial instrument. Or both the elements are equity and both the elements are equity instruments, then it is going to become equity instruments in nature. Which means that if one of the components is FL and other is EI, then it is CFI. Both components FL, both components equity, equity. So we have introduced now the flavor in terms of the issuer, that as an issuer, I would present the instrument as equity. I'll present the instrument as FL. I'll present the instrument as a compound financial instruments. Wow. I think before I proceed with another amendment, it is also necessary that we give you a presentation in the balance sheet perspection as well. Okay, maybe we can do that later, but as of now, I've understood one very important element at this stage. I said, suddenly you'll see the level slightly going up at this particular stage. But what is important is that you revise it and you understand this well. So I'm coming to the inputs in terms of the version number 2. I am not made any changes in step 2 as of now. I have not made any changes on the step number 2 as of now. I've just introduced you to one particular element, that mode of payment can be cash or shares. The company may decide to make a mode return in cash, the principal in equity share. So when you're going to read the questions now, you are going to very carefully decide that what is the mode of payment for each component of your obligation. Your obligation has got two elements, the principal and the return element. You need to watch out that the mode of payment for the return, the mode of payment for the principal is separate. So please run the three-step model separately. Apply the concept of three-step model to the principal separately, apply the three-step model to the return component separately, and then decide. And the combinations could be that one component FL, another FL, 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 FL. Equity, equity, equity. One is FL, one is equity. It becomes a CFI. That is one. Now, let me also introduce you to the amendment to the step number 2. Watch this carefully. I am now making the changes in terms of the step number 2. So for the version 2, I am now making a change in terms of the step number 2. Watch this carefully. I said earlier that if the mode of payment is cash, it is financial liability. I take back my words. Sir, is this what you're going to do every time we're going to understand the concept and you will override the concept? Yes, sometimes true. I said earlier that if the mode of payment is supposed to be cash, I said you're going to call this as financial liability? No. Now, if the mode of payment is cash, you cannot call it as a financial liability. If the mode of payment is cash, I will stop and I will evaluate. Now see how. As we said, there are two elements, or you can say two components of the obligation. One is a return and one is supposed to be the principal money. So there are two components. One is, we can say, is the return. So one of the components is the return, the interest and dividends, and one of the components is supposed to be a principal money. Now the examiner is going to give you some terminology in terms of return and in terms of the principal money. It's not that he will simply say that I am making a payment in cash. But you need to see that if the payment is made in cash, is it mandatory or is it discretionary? So when you look at the interest or when you look at the dividends, that is the return elements, you need to now watch out for the words that is the payment mandatory in nature or is it something which is discretionary in nature? You need to now watch out that is the payment mandatory in nature or is the payment discretionary in nature? So when you say the mode of payment is cash, I will say, okay, now please tell me, is it mandatory or is it discretionary? If the mode of payment is mandatory, then it is financial liability. If it is discretionary, then it is equity instrument. So I made some changes. I said that if the mode of payment is cash, don't jump to the conclusion that it's a financial liability. No. You need to see for the return element, is the return mandatory or is the return discretionary? If you say it is mandatory, there is an unavoidable obligation to pay. If it is discretionary, there is an unavoidable obligation to pay. Your component is going to be a financial liability only if there is an unavoidable obligation to pay. When the component is mandatory, it's an unavoidable obligation to pay. It's a financial liability. But if it is discretionary, it's my choice. And when it is my choice, then it becomes an equity instrument. Similarly, in terms of the principal component, you are going to see the terms used is redeemable or irredeemable in nature. I know what will suddenly come to your mind is, sir, the concept of irredeemable doesn't exist under the Companies Act. Well, there are many places where the Companies Act may not be in consonance with the Ind AS. So I'm not concerned with the fact, whether the concept of irredeemable is there under the Companies Act or not. We are looking at Ind AS in itself. So we are going to see the principal money is either redeemable or irredeemable. If it is redeemable in nature, then it is financial liability, and if it is irredeemable, it is equity instrument. So moral of the story, the step number 2 has got some massive changes now. And the massive changes are that when you're going to look at the step number 2 and the mode of payment is cash, you're not going to say financial liability immediately. I will sit down and watch and decide, okay, are you talking about the interest and dividend? Are you talking about the principal repayment? So let me check the terminology. So I will say that, okay, if you're looking at the mode of payment cash, let me see, are you talking of the return element or are you talking of the principal element? And let me see the terms. If the interest and dividend is mandatory, it is FL. If it is discretionary, it is equity. If the principal is redeemable, it is FL. And if it is irredeemable, it is equity in nature. I hope you got my point. So we will learn two things in terms of version number 2. You've understood, number 1, that you need to run the 3-step model separately. You need to run the 3-step model separately for each component of the instrument, and you need to consider the changes in the step number 2. You know what is coming to my mind at this particular stage now? My mind is thinking that I am ready almost to develop a total of 3 charts with you. The chart number 1, when the mode of payment is cash only. The chart number 2, when the mode of payment is supposed to be just equity shares. And the chart number 3, when the mode of payment is, let's say, cash and equity shares combo offer. Based on the version number 2, my mind is now working on 3 different charts. If I can make a visualization and understand if a mode of payment is cash, what do you call the instrument? If the mode of payment is equity shares, what do you call the instrument? And if the mode of payment is equity shares and cash combined, then what is the nature of the instrument? Wow. So I guess first let's try 1 or 2 simple combination. Let's test the waters. And then I think we can work on the 3 charts as well before we go to any version number 3. So let's do one thing. Let's test the waters. I am now going to give you 1 or 2 examples. I'm pretty confident that you will be able to decide on the nature of the instrument. So let's do one thing. Let's give you, as far as the return is concerned and as far as the principal is concerned, apply the changes in step number 2, apply the 3-step model separately for each component, and give me the decision. I'll wait for your answer. The return is going to be given in cash and it is mandatory in nature. What is coming to your mind? The return is given in cash and it is mandatory in nature. So what is coming in your mind? It's a cash payment, mandatory in nature. So is it FL or is it equity instrument? Mode of payment is cash and the terminology used is mandatory in nature. And that's rightly said, it is financial liability. The mode of payment out here is in the form of shares, and in this particular case, it is a variable number of shares. So would you like to decide that if it is a variable number of shares, then what is the element of principal? Variable, that would mean again a financial liability. So once you add up both the components, FL plus FL, that instrument becomes financial liability in nature. Great. Let's give you another one as well to try this out. Let's consider the mode of payment is same, that is cash, but it is discretionary in nature. It is supposed to be discretionary in nature. So what is coming to your mind if the mode of payment is cash and it is discretionary in nature? And that's right, it becomes equity instrument in nature. Wonderful indeed. And if you say that it is going to be a fixed number of equity shares for the principal money, then what is the nature? The principal money is going to be given in terms of fixed number of shares, and that also becomes equity instrument in nature. And now you can add up the two, equity plus equity. Overall, the instrument becomes equity in nature. Wow. I guess we're fairly comfortable now in terms of applying the step number 2 changes as well. That when you're looking in terms of the fact that the mode of payment is cash, don't conclude it's a financial liability. Go step by step, evaluate is it mandatory, discretionary. I want to make a statement at this stage and watch out that what is the reactions on that. Let me just give you 2 sentences. If you agree with these 2 sentences, I think your fundas are working great. My mind is now working that if the mode of payment is equity share, your focus point is fixed or variable. Agreed. If your mode of payment is supposed to be equity share, your focus point is fixed or variable, and that's how you decide. Agreed. Okay, I got the answer yes on that. That's wonderful indeed. Next. If your mode of payment is supposed to be cash, your focus point is redeemable, irredeemable, mandatory, and discretionary in nature. Correct? If your mode of payment is supposed to be, cash, then your focus point is mandatory, discretionary, and redeemable, irredeemable. That's right. So when you're looking at a problem, your mind has to be very focused that if the mode of payment is equity share, fixed variable is on the agenda. When the mode of payment is cash, mandatory, discretionary, and redeemable, irredeemable is on the agenda. And that's how you decide whether it is equity or financial liability. Now, another small little input before we do, the charts with you. We'll do the charts a little later. Let me first, I think, come to another point as well. What we've been discussing since morning is the standard Ind AS 32 presentation. Please watch me carefully, because I am now about to show you the presentation aspects of Ind AS 32. So watch this. This is my balance sheet. This is my balance sheet on the liability side. I'm not focusing on the asset side. I'm focusing from the issuer perspective. So the focus is on the liability side. So this is my balance sheet extract. And I'm focusing on the liability side, that is called equity and liability. I just want to remind you the format of the liability side. We've got equity comprising of equity share capital and comprising of other equity, as you already know. And then there is a liabilities. And on the liabilities, we start with non-current liabilities. And in the non-current liabilities, we've got borrowings. And this is represented by what is called financial liability. Now watch this very carefully. I've just given you an extract of the balance sheet to give you a presentation of how things are going to look like. How the things are going to look like from the presentation aspect. The issuer issues an instrument. It is called equity, or it is called financial liability, or it is called a CFI, that is a compound financial instruments. I am only telling you the presentation aspects now. If the issuer issues an instrument and it is called equity instrument, it will be a part of equity share capital. That's one. If the issuer issues an instrument and it is a financial liability. It is a part of the borrowings that is financial liability. Now, the interesting part is if the company issues a compound financial instrument, the compound financial instruments will be split into two components. How do you do the split? We're going to see that later, not even today. But I just want to put this in your mind at this stage. If the company issues a compound financial instruments, the total money raised by the company will be split into two components: the financial liability component and the equity component. So we will split this money. The financial liability will appear here and the equity element will appear here. The equity element will appear as a part of the other equity. Please get this clear. So when you look at a compound financial instruments, the proceeds of the money raised will be split into two elements. How the split will happen is something we'll see later. But we'll split this money in terms of financial liability and we'll split this money in terms of equity. The equity component of the compound instrument is going to be a part of the other equity in the balance sheet. And you already know that this other equity is elaborated by a document which is called SOKI, Statement of Changes in Equity. So we make a document illustrating the breakup of this other equity in the balance sheet, and that is called Statement of Changes in Equity, that is SOKI. So equity component of CFI will be a part of this other equity and the financial liability element as a part of FL. So what you need to know as a larger picture in terms of Index 32 presentation, when a company says it is FL, it's going to appear in the balance sheet as a non-current liability borrowings. When the company says it's an equity instrument, it appears in the balance sheet under equity share capital. When the company says it's a compound financial instruments, you need to split the money in terms of financial liability as a part of FL and the equity component not in the equity share capital, but it appears in other equity, and that is presented as a part of the other equity SOKI. I hope I'm clear on the picture. Now, I know if I ask you at this particular stage, how comfortable are you with the concept of SOKI and with the concept of OCI? Because I will build the concept accordingly in the next sessions to come, where I need to give you a larger picture of the other comprehensive income and in terms of SOKI. So how much comfortable are you with the concept of SOKI and with the concept of OCI? The linkage between recycling, no recycling, and other elements. Little shaky, though of course I remember giving these concepts earlier in the initial class where I gave the concept of other comprehensive income, but of course we didn't get into the technicalities of recycling and no recycling other things. But of course we will develop a concepts further out here as well. Okay, that's wonderful indeed. Right, so far so good. I guess I've given you the inputs. I think now it's a little time to give you some mental rest as well. I'm sure you'll feel a little need at this stage. Is your mind's getting a little heavy at this stage? Say no. Is your mind getting a little heavy at this stage? Say no. Because all I've done is just develop a version 1 and a version 2 of the 3-step model. We're yet to create some charts before we go to the version 3. Do some practice questions also with you on this particular area. I like it. You said a no on that. Okay, so let's do one thing. Let's first give you a small little break at this stage to get your minds refreshed. We'll take a 10-12 minutes break at this stage and then I'll commence back. What I'm going to do after the break, I am going to first of all create some charts with you. We're going to pick up some illustrations in the study mat as well, where I will just make a walkthrough of certain illustrations applying my chart number 1 to 3. And if the time permits, which I think may not, I will then try to touch upon the version number 3 as well. Otherwise, of course, we'll carry on the journey tomorrow in that case. So let's take a break, friends. Relax your minds. I join you in 10-12 minutes time. Thank you. Thank you. So I hope you had a relaxation of mind. Now, what I am planning to do at this stage before we work on the version number 3, I want to make some charts as I mentioned earlier. I'm going to make 3 charts as of now. If the mode of payment is purely cash, then what are the permutation combination? If the mode of payment is supposed to be, let's say, only equity shares, what are the permutation combinations? And if we blend the mode of payment as cash and equity shares, then what kind of permutations and combinations would come in? So I think if you're able to answer, I would say almost majority of the questions in this permutation combination, then I think your concepts are going pretty good. But I think before I make the chart, let's quickly take a recap in the mind, and then we are ready to make these charts with you. So your focus on a 3-step model is that number 1, you need to apply this 3-step model for each component separately. When I say each component separately, which means you will apply this to the return element separately and to the principal element separately. Then when your focus is cash, the terms which should trigger in the mind is mandatory, discretionary for a return, redeemable, irredeemable for the principal, and when the mode of payment is equity share, what should focus in the mind is fixed and variable in nature. So let's begin the journey. Try answering maximum questions you can. The more the questions you answer, the more the confidence you get on that. So let's begin the journey. I'm now going to make 3 charts with you. So my focus is on chart number 1. After you made the charts, then we'll do some questions in the study material as well. So first let's focus on the chart. In the chart number 1, I am considering the mode of payment to be purely cash. So I'm considering the mode of payment to be completely cash. Stephen, please give your email. You can send your queries to the email which is being given to you at the ICAI. And of course, it will be passed on to me if there is anything technical you want to address. Okay, so let's consider some permutation combinations to you. So I will take 2 elements. One is the return and one is the principal. So return is the interest and dividend, and this is the principal portion, and I want to decide the nature of the instrument. So let's begin with the permutation combinations, and you can keep answering as the permutation combination goes. Let's begin with the combination 1. The return is mandatory and the principal is redeemable in nature. Decide the nature, take your call for each component separately, and then decide FL will be FL, one of the components equity becomes a CFI. And that's rightly given. When I say mandatory, it is FL. When I say redeemable, it is FL. Both the components are financial liability. So undoubtedly, it becomes a financial liability. Great. Let's consider another combination, mandatory, and this is irredeemable in nature. I think you can easily decide that. Since it is mandatory, it is undoubtedly a financial liability, and if it is irredeemable in nature, you know it is supposed to be equity component in nature. So one FL, another equity, that makes it what? A compound financial instruments, and that's rightly said. This is CFI. I'm pretty sure that you will start making the combinations as well as I proceed. Let's take the third combination, discretionary. And let's consider this to be redeemable in nature. Now decide what is the nature of the instruments. Okay, I was getting some different answers. We're not discussing that at the moment. And that's right, it is CFI. This is equity and this is financial liability. So one element is FL, another element is equity. That makes it CFI. Great. Let's take the fourth combination, discretionary. And this is irredeemable in nature. And I think this will take care of all the permutation combinations as well. And that's rightly said. Quick indeed. This is equity instrument in nature because this is equity and this is also equity. Both the elements are equity in nature. And you can see that I very carefully created the permutation combinations for a basic understanding. I took the mandatory component and redeemable, irredeemable. I took the discretionary element, redeemable, irredeemable. That takes care of all the permutations and combination. So far, so good. I guess the chart number 1 is absolutely clear, where the mode of payment is kept only in terms of cash. The focus is mandatory, discretionary, redeemable, irredeemable in nature. Great. Let's go to the next chart. That is chart number 2. And the focus in terms of chart number 2, I want to consider the mode of payment to be equity shares only. And this is more based on the 2 illustrations I did earlier during the day. If you remember the illustration number 12, 13, or I think 13, 14, whatever was the number, in those cases, we saw the fixed and the variable concept. I guess the moment you look at equity share as a mode of payment, what comes in the mind is fixed and variable in nature. But let's put it in a little different style. I'm going to give you the permutation combinations slightly presented differently. So I think there will be 2 permutation combinations in this case. I guess I'm looking at the principal compounded at a given rate of interest for n number of years divided by the fair value on issue. That can be one kind of formula, I would say. The other one is that the principal is compounded at a given rate of interest for n years, and this is divided by fair value on the conversion date. So I think you can decide on the first one that I am dividing it by the fair value on the date of issue. That means you are deciding the number at the very inception. So it's a predetermined number because you're dividing it with the fair value at the time of issue of the instrument. So this will become what? That's right. This is going to become a case of fixed number of shares. And if it is fixed number of share, it undoubtedly becomes an equity instrument. And in this particular case, we're dividing it with the fair value on the date of conversion, which means the number will be decided at a later date. And if it is at a later date, it's a variable number of shares. And if it is a variable number of shares, we know it is supposed to be a financial liability. I don't see any other permutation combinations coming in if the mode of payment is supposed to be equity shares, because the focus is either a fixed or a variable number of shares. I think the chart number 2 would also be clear. I think now let's blend the chart number 1 and 2 put together, where let's consider the return in terms of cash and the principal in terms of shares, and let's see the permutation combination. Let's have a look at the chart number 3. So in the chart number 3, I'm going to consider mode of payment as both cash as well as equity shares. And I am going to consider the return in terms of cash, and I'm going to consider the principal in terms of share. So we're blending the chart number 1 and 2 put together, and we're going to create some permutation combination. Then we'll do a good level of practice also with you. So let's consider the principal and the return element. So I'm going to consider the mode of payment for return as cash. I'm going to consider the mode of payment for the principal as equity shares. And we will decide on the nature of the financial instrument. So let's give you the permutation combinations again. I'm very confident again that you will be able to easily answer the combination. Let's consider the return is mandatory, and let's consider the principal is paid in terms of variable number of shares. I guess you can decide easily, and that's rightly said, it is a financial liability. Mandatory return makes it an FL, variable share makes it FL, so both the components are FL, so it is undoubtedly a financial liability. Super. Let's take the next combination. It is mandatory, and let's consider this as fixed number of shares. I guess you can easily decide this combination as well. And that's rightly said, it is a compound financial instruments because this is a FL and this is equity that makes it a compound financial instrument. Superb. Let's consider another combination. You know what I am going to do. This is discretionary and this is variable in number. So now decide the permutation combinations in this case. That's rightly said. This is equity and this is liability. It becomes a compound financial instruments again. Super. Let's put the fourth combination, discretionary, and let's consider this as fixed number of shares, and you can decide the permutation combination, and that's brilliant indeed. It is equity instrument indeed. Wow. And you would have noticed that I've taken this mandatory variable fixed, discretionary variable fixed. So all the permutation combinations are flowing in a very logical sequence indeed. Wow. So my chart number 1, 2, 3 is done. So I am pretty confident based on your answers that we're very clear with the version number 2. So version number 2 is focusing that you need to evaluate the principal and the return element on a separate basis. The version number 2 focuses that if the mode of payment is cash, then you're looking at mandatory, discretionary, redeemable, irredeemable. And when the mode of payment is supposed to be, equity shares, your focus is fixed and variable in nature. Can I do one thing? Yes, I can. I want you to give yourself a comfort number on a scale of 10 because sometimes I am in a habit, because we can't see you on a digital level. But I want you to give yourself a score, not me a score, but you need to give yourself a score on your comfort zone so far at this stage. On a scale of 10, what do you think is your comfort zone at this stage? Wow, we start with the score 10 by 10 and we've got a score 9. That's quite encouraging indeed. And we've got another score 10 by 10 and 9. That's brilliant indeed. I think a little revision would make that 9 as 10 as well. That's great. Okay. So I think now we are ready to do some questions in the study material with you. So I am now going to pick up some questions with you. What happened on this? Oh, it is suddenly closed. Too dangerous a concept, suddenly it closes off. Did I say so much technical things in the morning? Just give me a second. It gets loaded. I hope the file is saved. Otherwise, we are about in a lot of trouble indeed. Hopefully, the file should get saved, I guess. Great. We are saved. The file is saved. Okay, just give me a minute. I think it'll just get loaded. Technology sometimes has got its own challenges in life. Okay, wonderful. I think we have saved it. So I am now just going to take you to a few inputs, illustrations in the study mat. Okay, here we are. This is the illustrations in the unit number 3. Illustration number 1 in unit number 3. I'm just going to read the inputs to you. Please don't look at the answers. You just need to apply the charts based on the 3-step model and you will easily get the answer. In fact, you can do something very interesting indeed. Once you make a revision of this particular class, what you can do, you can map up these illustrations in accordance with the charts I've given you. Map up that in chart number 1, these are the illustrations. It'll help you later for a quicker revision. I think that's what you can do. Let's begin with the illustration number 1. It says A is the issuer which issues preference shares to B. The preference shares are redeemable at the end of 10 years from the date of issue and entitles the holder to a cumulative dividend of 15% per annum, and the rate of dividend is commensurate with the credit risk profile of the issuer. Examine the nature of the instrument. You're given it is redeemable, you're given the dividend is cumulative in nature. You need to apply the 3-step model to each component separately. If it is redeemable in nature, it is financial liability. If it is supposed to be a cumulative dividend, which means that it is mandatory, your dividend liability will not lapse even if you're not able to make a payment due to inadequate profits. It is going to be carried forward and paid. So it is something which is mandatory in nature. So both the elements are financial liability. And I think you rightly gave the answer. This is FL and this is also FL. Overall, the instrument becomes a financial liability. Superb. So that's the answer given, financial liability in its entirety. Okay, that was simple. Let's look at another one. Let's see the illustration number 2. I guess the visibility is okay. I'll just keep all the illustrations in one go. Is this good to watch? Maybe I can hide the answer out here. So this should be good. Okay, so let's have a look out here. Great. Illustration number 2, it says X company is the issuer. It issues debentures to Y. The debentures are redeemable at the end of 10 years from the date of issue. Interest is payable at the discretion of the issuer. The rate of interest is commensurate with the credit risk profile of the issuer. Examine the nature of the instrument. It is redeemable, that's 1, and the dividend is at the discretion of the issuer, that's 2. Wonderful indeed. Redeemable means it is a financial liability. Discretion means it is equity instrument. Put together, it becomes a compound financial instruments in this case. Superb. So in this particular case, we are clearly given, and it says this is a compound financial instruments, though discussions are done later. Okay, let's now look at illustration number 3. It says they have taken a loan from Q. P company issuer has taken a loan from Q, and the loan is perpetual and entitles the holder to a fixed rate of interest at the rate of 8%. Now, this is one illustration which I want to discuss in a more detail. It is supposed to be a perpetual, that means an irredeemable debt, and then it says the holder is entitled to a fixed rate of 8%. I think let's get your inputs on that. So I think I'm getting the inputs. It is a CFI. What we have learned so far, what you're saying is technically correct. But let me do one thing. I want to now focus on this illustration in a little more detail. I remember, somebody was saying something earlier, and I did not, say that we're discussing that. I said, I'll come back to your points later. But somebody made some inputs at that stage, and somebody said, that it depends upon the market rate of interest, etc. I said, it's a little early to discuss that, but I think let's discuss this part now. So I guess now let me do one thing. Let me just do some discussions with you. Now, please watch this carefully, because this is another area which is going to be slightly technical, but you'll understand. I'm going to use a little concept of time value of money. Now, watch this carefully. I'm taking a simple example to illustrate the point. Let's say a company raised a debt and it is irredeemable in nature. The company raised a debt and it is irredeemable in nature. I am just going to give you a very basic flavor of a split accounting. I'm just going to explain to you how the split accounting in terms of compound financial instrument takes place. So the next 5-10 minutes is going to be a little more crucial because you're about to learn something new, which we will discuss more in detail when I come to the split accounting of compound financial instruments. Now, first of all, let's understand the concept of a financial liability. Please watch this carefully and please hear this carefully. Let's say I raised 10 lakh rupee. Is that my liability? No. My liability is not the amount I raise. My liability is the principal repayment and the interest repayments which I am going to pay in the future. So when you tell me that what is the amount of financial liability, so let's say for example, if you raised an amount of money, you raised let's say 10 lakh rupee, I cannot say that 10 lakh is my liability. My liability is that I will pay interest on that loan for n number of years and I will pay the principal money back after n number of years. So my liability is, you can say, the interest I'll pay for n years and the principal I'll pay at the end of the nth year, and this will be discounted to time value of money. Because if you want to measure the liability today, you know that you're going to make some future payments tomorrow, and all those future payments, if they are discounted at time value money, that is a liability. So when it comes to a measurement of a liability, the liability is never equal to the amount raised. If a company raises a debt for 10 lakh, you cannot say my liability is 10 lakh. I'll say the measurement is supposed to be based on the present value of future cash outflows. I'll put it like this, that the measurement of a financial liability is based on the present value of the future cash outflow. And when you look at the future cash outflow, it is going to comprise of the interest payments to be made in the future, and it will also comprise of the principal payments which you are going to make in the future. So remember one thing, that liability is going to be measured not at the amount which you raise today. Liability is going to be measured at the present value of all the future payments. The interest which you will pay, the principal which you will pay is going to be discounted. Now, watch this carefully. When you're going to consider a discounting, the discounting in this particular case, as of now, to understand this present value means you need to consider a discount rate, and this will be, let's consider for the time being, a market rate of interest. So when I am going to calculate the present value of all the future obligations, I will consider a discounting rate which is a market rate of interest. Now, let's understand one very important input in terms of discounting. Let's say I borrowed 100 rupees and I am going to pay, let's say, a 10% interest for a period of 1 year. So when I borrowed 100 rupees and I'm going to pay interest at the rate of 10%, so you are going to add 10% and the money which you're going to pay after 1 year is 110. So what is my liability? Is my liability this 100 rupees? Of course not. What is my liability? Is it the present value of this 110? Yes. And I will calculate the present value of this 110 at the market rate of interest. Now imagine if the market rate of interest is also at the rate of 10%, you will get the answer 100 itself. Now watch this maths carefully. If you're going to pay interest at the rate of 10%, you compounded interest at 10. And if you discounted at 10%, you reach back the same answer. If the rate at which the compounding took place and the rate at which a discounting took place is same, you are going to reach the same answer. Let me put it again. Mind the words carefully. So what I'm saying, that when I borrow money, my liability is not the amount I borrow. My liability is supposed to be the present value of all the future obligations. So what I need to do, I need to consider a discounted value of all the future payments, and this discounting is done at the market rate. This 10% is supposed to be, you can say, the coupon rate which is decided in the deal. The 10% which you plan to pay to the other person is the coupon rate which is decided in the deal. But when you're considering this 10%, this is the market rate of interest. Now, what you need to consider in this case is the rate at which you compound and the rate at which you discount if it is same. As you can see mathematically, the rate at which you compound and the rate at which you discount, if it is supposed to be the same, you are definitely going to reach the same answer. But what happens if you compound at a different rate and you discount at a different rate? You don't reach the same answer. That is one thing. So please keep this mathematics at the back of your mind, that the rate at which you compound and the rate at which you discount, if it is going to be equal, then in that particular case, we can say the answer will come the same. You compound at 10, you discount at 10, you reach the answer same. But if you compound at a different rate and you discount at a different rate, you will definitely reach a different answer. That is one input. Next. The next input, what I want to make, now let's come back to the irredeemable debt. Now, in terms of irredeemable debt, let's say, for example, a company raised 10 lakh rupees on an irredeemable debt, and let's say the rate of interest on this is, let's say, at the rate of 10%. So let's consider the company issued, a debt of 10 lakh rupees and the rate of interest is supposed to be 10% on this. Let's say this is equal to the market rate itself. Let's assume that this rate of interest and the market rate is equal. The coupon rate decided and the market rate decided is equal. Now, what is my liability? Is it 10 lakh rupees which I raised, or is it the present value of all the future payments? It is the present value of all the future payments. And based on financial management, that if it is an irredeemable debt, there is supposed to be only an interest payment which will be paid forever. You are going to make a payment of interest which is an annuity till a perpetuity, because you keep going to make a payment of interest forever. So what is my future payment? My future payment in this particular case is, on 10 lakh rupees, you're paying a 10% interest. So the interest which you're paying is the annuity till perpetuity. So I am going to make a payment of 1 lakh rupees forever. And if I need a present value of that 1 lakh, I will use the concept that is A by R. What I do in financial management, this annuity will be discounted at 10% rate of interest, and this works out at 10 lakhs itself. So you can notice that the money which is raised is 10 lakh rupee, and the present value of that amount is also 10 lakh rupee. So if the proceeds is 10 lakh rupees and the liability is 10 lakh rupees, that means this instrument has got no equity component. Because if you raise 10 lakh rupee and you calculate that the liability element is 10 lakh, the full amount raised is the liability element. There is no equity element. It will not become a compound financial instrument. So can you please put that all over again, what you are discussing at this stage? So what would be the market rate of interest? No worries, I will come to that. But let me just consolidate a little mathematics at this stage. I made two things very clear as I make a walkthrough in terms of this example. The first thing which you need to understand is, though I am going a little step ahead, but I am trying to make a point that when you raise money, when you borrow money, the financial liability is not measured at the amount which you raise. So for example, if I take a loan of 10 lakh rupee, my liability is not 10 lakh rupees. Get this very clear. In this entire standard on financial instruments, whenever you will tell me to measure the financial liability, I will say financial liability is not the money which I've raised. If you take a bank loan of 10 lakh rupees, my liability is not that 10 lakh rupee, the money which I've raised. My liability is supposed to be the present value of all the future payments. So my liability is not what I receive, though my liability is what I am going to pay. So get this one thing very clear at the back of the mind. Liability is never the amount you raise. Liability is not what you receive at time zero. Liability is what you're going to pay in the future. And since you're going to make a payment in the future, it needs to be discounted to time value money. So we decided the measurement of the liability is based on the present value of all the interest and the principal money. And the interesting part is, when you need to consider a present value, you need to consider a present value based on a market rate of interest. Now, how do you get that market rate of interest? All that discussions we'll be doing later. At this stage, my focus is not how do you derive that market rate of interest. My focus is that if you enter into a deal, your contracted rate is 10%. The coupon rate agreed is called the contracted rate. But I will not discount things at the contracted rate. I will discount things at the market rate. Now you need to see the simple maths that if you are compounding at the rate of 10%, which is the coupon rate or which is the contracted rate, and you discount also at 10%, you will reach the same answer. Which means if you land up paying 10% as a contracted rate, which is also a market rate, and then you discount at 10%, the money raised will be equal to the liability. The full amount will be called as a liability. Now, applying this particular concept of discounting in this case, let's say a company raised a debt which is irredeemable in nature. If the company raised a debt which is irredeemable in nature, what is my liability? Is it the 10 lakh rupees which I raised? Of course not. So in this particular case, I am going to pay a coupon rate of 10% on this money forever. So it's like an annuity which I will be making a payment forever, and we know the present value of annuity till perpetuity is supposed to be A by R. This annuity of 1 lakh rupee will be discounted at a market rate of interest, and let's consider that the market rate of interest is also 10. So when you divide this annuity of 1 lakh by 10%, you reach the same answer. This 10 lakh rupees is technically called a fair value of the liability. And this 10 lakh rupees which you have raised today is technically called a transaction value. You can say this is the proceeds or this is the transaction value, and this is supposed to be the fair value. Now you've reached an answer where the transaction value and the fair value is same. Your proceeds are 10 lakh and your liability is 10 lakh. So the entire 10 lakh is supposed to be liability. There is no equity element. So in this particular case, we can say it is not a compound financial instrument. Did you get my point? In this particular case, I can say it is not a compound financial instrument, because out of this 10 lakh rupees, if entire 10 lakhs is a financial liability element, then there is no balancing figure. And if there is no balancing figure, there is no equity element. Now, let's assume that in this particular case, for the time being, the market rate of interest, instead of saying 10%, is, let's say, 12%. Assume that the market rate of interest is 12. I am making a payment at the rate of 10% on a contractual basis, but the market rate is 12%. How would you calculate the liability? The annuity is 1 lakh rupee and you're going to divide this by 12%. So if you're going to divide this 1 lakh rupees by 12%, it comes to 8.33 lakhs. This is the financial liability element. So we can say that out of this 10 lakh, the remaining 1.67 lakh becomes the equity element of the instrument. So if out of the proceeds of 10 lakh rupee, 8.33 is the liability element, the remaining 1.67 lakh is supposed to be the equity element, and therefore it becomes a compound financial instrument. So in this particular case, it will become a case of compound financial instrument. So what do you want to prove? I want to basically now make a sentence based on this analysis, and you can vouch me. I have done two cases out here. The case number one. The case number one, I said, if the market rate and the contracted rate is same. If the market rate and the contracted rate is same, it is going to be a financial liability. And if the market rate and the contracted rate is different, it is 10% and the market rate is 12%, it becomes a compound financial instrument. So am I trying to indirectly say that if it is an irredeemable debt, you cannot directly say that it is an equity component? Of course, that's the point I want to make. You cannot directly now start reading the question and say that it is irredeemable. I say, aha, irredeemable means that it is supposed to be, a compound financial instruments? No. Everything depends upon the rate of interest. If the contracted rate and the market rate is same, irredeemable instrument will become a financial liability. And if the market rate and the contracted rates are different, then it will become a compound financial instruments. Did you get my point? I know what I'm saying is slightly technical indeed. Did you get my point, I guess? Okay, wonderful indeed. Let me also give you some more insights now. If you would have noticed out here, and even if did you not notice, I want to first of all show you something very interesting to watch out here. As I was reading the illustration number 2, illustration 1, 2 and all, I did not lay a stress on one particular input, but I think now it's time to lay a stress on this issue. Look at the illustration 1 again. It says the rate of dividend is commensurate with the credit risk profile of the issuer. When it says the rate of dividend is commensurate with the risk profile of the issuer, I am indirectly saying that the contracted rate of interest and the market rate of interest is same. There is no suppression in terms of the interest liability. Mind the words. When it says the rate of dividend is commensurate with the credit risk profile of the issuer, it means nowhere is the issuer trying to suppress his liability. Because if the contracted rate is 10% and the market rate is 12%, the issuer is trying to suppress his liability, which indirectly means a compound financial instrument will also get triggered when a person tries to suppress his liability. When as an issuer of the instrument, I am trying to suppress my liability either by way of paying a lesser interest as compared to the market terms, it will give rise to an equity element. Mind the words I'm saying. So when it says the rate of dividend is commensurate with the credit risk profile, it means that the coupon rate agreed and the market rate is the same. Similarly, let's have a look further. In this case also, the sentence is given the rate of interest is commensurate with the credit risk profile of the issuer. That means the contracted rate and the market rate of interest is again the same. There has been no imbalance in terms of what you're paying and what you should have paid based on the market terms. And now if you see illustration number 3, it says the loan is perpetual in nature and there is a fixed interest 8%. Now the question what comes to the mind is this 8% commensurate? Is it equal to the market rate of interest? If you say a yes, it is a financial liability. If you say a no, it is a compound financial instrument. So when a company would issue an irredeemable, a perpetual debt instrument or a perpetual preference shares, you need to be watchful that is the interest rate given on the instrument equal to the market rate or is it below the market rate? If it is equal to the market rate, then it is supposed to be FL. But if the rate of interest given is below the market rate, then it is CFI. Don't worry, I'll document that. See, it says the instrument has got two components. There is a mandatory interest and there is a perpetual nature of the principal amount. The first component to deliver cash to the lender cannot be avoided, and this is a financial liability. The same illustration is given elsewhere in the study as well. The same illustration is given in the appendix to Index 32 as well. And in the appendix, they very clearly made a mention in the standard that if this instrument, the rate of interest is commensurate to the market rate of interest, it is a financial liability. It is only if the rate of interest is suppressed, the contracted rate is below as compared to the market rate, it becomes a compound financial instrument. Moral of the story. If the company issues a company issues an irredeemable, a perpetual instrument, be careful. Put across a question, is the rate of interest equal to the market or different? Accordingly, it can be FL, accordingly, it can be CFI. A very interesting point indeed. I think let's make a note at this stage on this point. So let me just add something at this stage. And this is if you're looking at a perpetual or what we call an irredeemable instrument. So if you're looking at a perpetual or you're looking at an irredeemable instrument, I would say you need to compare. I would say you need to make a comparison. You should compare the two things. Compare what is the contracted rate. So this is another input I've added on, and you need to compare this with the market rate. So there are going to be two permutation combinations which can arise out of this. So either we can say that the contracted rate and market rate is same, or we can say the contracted rate is less. You will not have a situation where the contracted rate is more than the market rate. That's not possible. So either the contracted and the market rate is equal or the contracted rate is less. You cannot land up paying more than that. So if it is equal, then I would say it is a financial liability. But if it is supposed to be less, it is definitely a compound financial instrument. So this is what you need to keep in mind. A perpetual or irredeemable debt instruments are not going to be called as a compound financial instrument. So next time you see the word perpetual, start looking at the comparison of the interest rates as well. Start looking at, is the coupon rate decided and the market rate decided, is it same or is it not? I hope, friends, I've made my position very clear on this. Let's go back. Okay, so let's have a look back out here. Illustration 3 done. Now let's have a little look at illustration 4. Though illustration 4 is not exactly a illustration on the concept of identifying the instrument is FL or equity, it is more like a clarification. And I think before I read the illustration, let me clarify that agenda as well. An inability of the company to pay its obligation, would it change the status of the obligation to an equity instrument? The answer is a big no. If the company is under a contractual obligation to pay, but its inability to pay this money due to any reasons whatsoever cannot undermine the fact that it's not a financial liability. That's what is given in illustration number 4. Does the lack of access to foreign currency or the need to obtain approval for payment will lead to a contractual obligation? Well, your inability to pay because of restrictions or whatever cannot undermine the liability. The liability continues to be a financial liability in this case. Okay, so let's have a further look out here. We're going to look at illustration number 5. So let's see illustration 5. It says D issues preference shares to G. The holder has got an option to convert these preference shares to equity instruments at any time up to a period of 10 years. If the option is not exercised, the preference shares are redeemed at the end of 10 years. Examine the nature of the instrument. We are not doing this illustration as of now. The idea of reading this illustration is to add something more at this particular stage. I know your mind must be getting a little heavier at this stage, and putting on something additional at this stage could be a little overburdensome, but I still want to make some points at this stage. Let me just come back on the agenda of discussions and watch me carefully. I think let me do one thing first of all. Let's first make a quick mind map on things. And then I am going to introduce an element of discussion so that I can start moving to my version number 3. If you remember, I had given you the inputs that we are going to work on a 3-step model in 3 stages, in 3 versions. The version 1 and version 2 is done, but the version 3 is pending. So let's do one thing first of all. Let's consolidate things. Let's get it very clear before we step on to the version 3. So let me first make a mind map. So you can start making this mind map with me. In fact, you will feel the need of these mind maps as we progress in the standard. And I want to, basically make a very earnest request to all of you. Since it's a bigger standard, naturally, when you're done with the class 1 of this particular standard, you may feel slightly heavy, but still quite comfortable indeed. But when you're done with like 2nd and 3rd class, you'll start feeling heavy and you will feel the need of the connectivity as well. So get into the habit of doing a cumulative revision for this kind of standard. When I say a cumulative revision, it means you revise the class 1, you go to the class 2, revise 1 and 2 both. You go to the class number 3, you revise 1, 2 and 3, all 3. In between also, I will also help you to keep, relating what we have done. Because as we'll keep making a progress, there will be a lot of interlinking which needs to be developed in the mind. You need to be very clear on how the sequence of flow of this particular standard is moving. So I'll keep giving you that flow as well. I'll keep making some mind maps as well. But you also need to do a cumulative revision to get a good grip on this particular standard. So let's make a mind map number 1 today. Now my mind is working very clear that when I am looking at a financial instrument, so my mind is very clear on the agenda that when I'm looking at a financial instrument, my mind immediately tells me that there are 2 parties. And now since my understanding has got developed to a next level, my mind is immediately telling me that out of these 2 parties, we can say the first one is called an issuer and the second one is called an holder. The holder is the one which is supposed to present the asset side of the balance sheet. And the issuer is the one which needs to present the instrument on the liability side of the balance sheet. That is one focus which should immediately come to your mind. And now, since we know that when you're looking at the issuer perspective, he may say it is a financial liability, he may say it is an equity instrument, or he may say it is a compound financial instrument, because now we already know that. So he may land up saying it's a financial liability or equity instrument or a CFI, but we can say irrespective, he is going to call them as a financial asset only. So whether it is a financial liability or equity instrument or a compound financial instrument, the holder lands up saying only a financial asset. So my focus turned towards the issuer. And for this particular purpose, what we decided, that if you want to decide this, you need to apply a 3-step model. So we need to apply a 3-step model for the purpose of deciding that the instrument is supposed to be a financial liability, equity instrument, or a CFI. And I've also given you 3 charts as well. So the fate of this 3-step model with the 3 charts and also a clarification which I've given you. And also a clarification which I've given you for a perpetual debt. So these are the few things which you need to keep in mind in terms of the classification. Your mind should start working absolutely great. That there is a 3-step model and there are 3 charts which are given and there is a clarification which is given. Now, moving further. So when I started working on my 3-step model, When I started working on my three-step model, my mind started working absolutely on one tune, that there are two components of the obligation. So as I start with my three-step model, we said that the obligation on an instrument has got two components. So the obligation of an instrument has got two components. There is a return element. The return element is in the form of interest as well as dividends, and there is a principal element. So as you start off with your three-step model, immediately what should come to the mind is that obligation has got two elements. So there is a return element, the interest and the dividends, and there is a principal element. And immediately what should come to the mind is that we need to apply the three-step model separately. So we need to apply the three-step model separately to each component. We need to apply this to each component. So we'll get into the habit of deciding that we need to apply the three-step model to each and every component on a separate basis. That is your very first focus point. Then, as we proceed in terms of step number 1 and step number 2 and step number 3, we've got some more focus points coming in. Your step number 1 focuses on the obligation being contractual, not legal in nature. So you need to focus that when you're looking at the obligation, so the focus is the obligation is something which is contractual in nature. So we said that contractual is just one element of a legal obligation. Legal obligation is the wider term, and within that legal obligation is a contractual obligation. The focus is that it's a contractual obligation. The second focus point is the mode of payment, which can be either cash or which can be either in the form of shares. The company uses its own equity shares as a currency note. And when you focus on the mode of payment being cash, immediately what comes to your mind is, okay, if the mode of payment is cash, let me get the focus points clear. If you're looking at a return, you need to concentrate on the terms mandatory and discretionary. Mandatory is FL, discretionary is equity. When you're looking in terms of the principal component, you will concentrate on redeemable and irredeemable in nature. And when you're focusing on redeemable and irredeemable in nature, generally, when you say it is redeemable, it is a financial liability, and when it is irredeemable, it is equity. But we decided something very interesting, and we said if it is irredeemable in nature, you need to compare the contracted rate. You need to compare the contracted rate versus the market rate. And of course, we made a decision in this particular case that if the contracted rate is equal to the market rate, it is a financial liability. But if the contracted rate is less than the market rate, then it is supposed to be a compound financial instrument. So as an exception to this particular part, we said even if the instrument is irredeemable in nature, don't land up saying that it is supposed to be equity component. You need to see that the rate of interest in this case is equal to the market rate or not, and accordingly it could be FL or accordingly it could be a CFI. So that was one extension. When the mode of payment is supposed to be shares in this particular case, then there is another focus point. And in this particular case, the focus point is in terms of, is it a fixed number of shares or is it a variable number of shares? So when it is supposed to be a fixed number of shares, then in this particular case, we say it is an equity instrument. And if it is a variable number of shares, then we say it is supposed to be a financial liability. So within my three-step model, I've covered up the classifications, and based on the three-step model, I have already given you 3 charts. Those three charts were basically explaining the nitty-gritties in terms of all these permutation combination. I guess friends, so far so good. We are all absolutely clear with the agenda so far, right? Crystal clear. That's wonderful indeed. Okay, now I want to add on something because I want to take the chain of thoughts further. And I am working towards my version number 3. My version 1, version 2 is done. Now I am going to make some inputs on the version 3. Now please hear me carefully, because in the version number 3, I need to add some inputs which we are going to work on this not today. We will work upon this agenda tomorrow, but I want to make a base on the version number 3. So watch me carefully. Watch me very carefully. There are 3 kinds of financial instruments. I think before you start thinking that it's liability, equity, or CFI, that is from the issuer perspective. I'm looking at financial instruments in general. There are financial instruments which are called non-derivative. There are financial instruments which are called non-derivative in nature. There are financial instruments which are derivative in nature. And there are financial instruments which is both non-derivative and derivative. Mix. So it is a blend of non-derivative as well as derivative in nature. Wow. You know, my discussion so far today, whatever discussion I've done so far today, is based on instruments which are non-derivative in nature. So we will be coming to the concept now that if the instruments are derivative in nature, then what happens? If the instruments are something which has got derivative and non-derivative. So, but what exactly do you mean by derivative in nature? I don't know, friends, but let me ask you, do you know what is a derivative? Do I need to explain you that what a derivative is? Do I need to explain you what forwards, futures, and options are? Or can I safely assume that you've got understanding on what is a derivative and what are forwards, futures, option? I don't need very technical understanding on the agenda, but some kind of a basic understanding which will help you to understand the concept further. So can I take the presumption? No means that you don't have the understanding. Options are not clear. Okay. That means I will also have to spend a little time with you, giving you some understanding on what a derivative is, because unless you know what a derivative is, we can't really understand that which instruments are pure derivatives in nature. But let me tell you one thing. Whatever I have done today, whether it was chart number 1 or chart number 2 or chart number 3, they're all based on instruments which are non-derivative in nature. We will be coming to instruments later, and I will be making, a chart number 4. Rather, I will not make a chart on this one. I'll not make a chart on this one. I will make a chart number 4 on this area. Now, as far as derivative instruments are concerned, derivative instruments basically are instruments like forwards, futures, option. I think even if you got a very basic idea, you know that these are all derivative instruments, but we will understand what is a derivative instruments. But this is something which is called pure derivatives in nature, and this is what is called hybrid instruments. So this is what is technically called hybrid instruments. This is what we call hybrid instruments in nature. Instrument which has got both derivative and non-derivative elements are hybrid in nature. If you remember, I was reading the illustration number 5, and after reading the illustration 5, I said we cannot do that illustration as of now. And the reason that you cannot do that illustration as of now is for the reason that they were basically based on what we can say hybrid instruments. And I want to just, show you something at this stage. As we were looking at that illustration, I just want to go quickly back to the illustration to show you something at this stage. Look at this illustration number 5. It says in this illustration number 5, D issues preference shares and the holder has got an option to convert. The holder has got an option to convert. When the holder gets an option to convert, this option is like the derivative option. And when it is a derivative option, the instrument which is the debenture, because it is supposed to be preference share. The preference share per se is a non-derivative and the option to convert is the derivative which is embedded in the instrument. So we are going to call them as hybrid instruments, which are non-derivative instruments with, you can say, derivative embedded in those instruments. Nothing more than that. I think it will be too technical to discuss anything further. I think I am done for the day. But it was very interesting indeed to lay down the foundations. I think you have understood the sequence today. You're going to enjoy this particular standard. And trust me, there is a lot more to go, but a very, very interesting standard indeed. Okay, so we're really enjoying the lecture. The concepts getting much clearer. Thank you very much. Thank you indeed. That's really great. Great class, sir. Thank you so much indeed. That's quite encouraging indeed for me. Looking forward to meet you all tomorrow morning at the same time. So if you got any questions, you can ask me. Otherwise, I think we're going to call it a day. Let me see if there are any questions on the other side. Okay, clear. Wonderful indeed. Okay, so far so good. Then in that case, then I think it's time to bid you goodbye, friends, on that. So I'm going to see you tomorrow morning, but please revise whatever we have done today. We'll meet you back tomorrow. Thank you. Bye-bye and take care.
Thank you, sir.
Thank you.
Thank you, sir.
Thank you.